What's up, guys? Today I want to talk about the stock market, how it works, what is the stock market, essentially how it was developed, and how you can participate. Essentially, the stock market is a platform or an auction, I should say. It's an auction to buy and sell portions of company, shares of company that are publicly traded. So obviously you can't buy every company. You probably know somebody that's a business owner, a small business owner, and their company's not available to buy and sell on the stock market. But larger companies that have made the decision to go public are on the stock market on this auction, and you can buy and sell those as you wish through your brokerage firm. Essentially, like going back centuries, people have used other people's money in order to do more business, right? So if you owned a trading company, you might have camels or horses or ships or whatever, and you would go to another place, trade, buy and sell goods and services, bring those back, flip them for more money, and then you would pay your investors back. So why would you use investors? In order to do bigger business, to buy more ships, to buy more camels, to pay more employees. Like, you would need other people's businesses or money in order to grow faster, do bigger deals, expand your reach, etc. And it's no different today. Companies have become more complex and varied, but the idea is the same. And so the investor, there's two basic kinds of investors. Like, one would be a financer, where I say, I'm going to give you my cash. You can take my cash, do your thing. You'll give me my cash back plus some. Or there's an investor where I become a part owner of the company, and that's what the stock market offers. So when someone starts a company, they either have to fund it themselves, or they'll seek out funding from other people, friends, family, or just other somewhat wealthy people that are interested in funding their business. At that point, the business is still privately owned and is not open for buying and selling on the stock market, and so you can't really get in on those companies, right? But if the company continues to grow and they hit a certain point where they're thinking, like, we could use public capital in order to grow much faster and expand our reach and things like that, and so they can go through what's called an IPO, an initial public offering, and essentially that's their official launch onto the stock market as a publicly traded company, meaning anyone that has an account, an online account through a brokerage firm, can buy and sell shares of that company as they wish. So they're giving up a certain amount of ownership to the general public to buy and sell. And so what they do is essentially they'll chop up the ownership of that business into thousands or even millions of shares, designate a kind of a starting price, and then take that public and try and sell that to the public that's trading on the stock market for that price. And then the price starts to vary. So as I say I see a company going public and I want in on it, they make their offering, and now let's say they hit the market at $10 per share, but people start saying, like, they believe in this company, they think it's going to go improve very quickly for the long term or whatever, and so they become willing to pay $10, $11, $12, $13, $14 per share in order to be an owner of that company. And that's what drives the price. If I believe that company will someday be worth much more than it is today, I want to buy, right? And so I'm willing to buy at a certain price point. So as business analysts see companies that appear to be profitable or will be profitable soon, or their future is bright, they're going to be buying. And when there's lots of buyers because of the bright future of a company, the price is going to climb rapidly. So that's kind of what drives it. You are literally buying ownership of a company. So let's just pick a famous one: Walmart, Amazon, Apple, whatever. Those big companies that have been publicly traded for quite some time, they've got millions of shares available to purchase out on the market. I own actually all three of those. If you own an iPhone, thank you for your business. Obviously, I'm not a majority owner. I only own a handful of shares of these companies, and therefore I don't get any rights as far as how we manage the company. There's regulations as to who gets to have sort of input and who doesn't, and how much input. So I can vote on certain things as owners of certain companies, but I really don't have much influence on the operations of that company. If you own the majority of shares, meaning like more than half the shares, you are the majority shareholder, and you have sort of much more power in the company. But to get that level in most publicly traded companies, you're going to need hundreds of millions of dollars. And so for the small guys like us, we're just talking about buying small shares and letting it run. So when you buy your first company, you'll literally be a part owner in that company, and you have the option to hang on to that ownership for as long as you'd like, or you can go back to the stock market and list your shares for sale. And if someone wants to buy at the price that you're willing to sell, it will sell. So essentially all you have to do in order to participate in this auction is sign up for an account through one of the online brokerage firms that there are many. There's Ameritrade and E-Trade and JP Morgan and Charles Schwab and Fidelity. There's a whole bunch. That's only a few. There's a bunch more. And you sign up for an account with one of those firms, fund it, put some money in there. It essentially sits in your account similar to like a bank account until you actually purchase a stock. And you can bid. So you can say, I'm willing to pay this much for this stock. And if it ever dips below that price, it will purchase. Same thing when you're selling. You can say, I want to sell it for here or more. And if that price ever hits that, your stock will sell to the available buyers. Or you can just put in market orders and say, I'm willing to sell at the closest bid right now. I'll get into the details on some of these things later, but depending on the volume of trades being made on that company, you may want to use one method over the other. But as an owner, you get to decide how long you're going to hang on to it and when you're willing to sell and for what price. As a buyer, you get to decide what price you're willing to pay to buy that stock and own that stock. Owning stocks is often profitable because the business's primary interest is to increase profits by expanding their reach and impact, by selling more products and services, whether that's new ones or more of whatever they make, and to continually find ways to produce it cheaper and sell it for as much profit as they can. So as a company achieves that goal, the price per share is going to go up, because as buyers, we're sitting here going like, what I started with the video, right? This company seems to be doing a good job and has a bright future. I need to buy now, and over time it will go up. It's no different than if you were to start your own business. The more money you make at your business, the more valuable that business is to potential buyers if you ever were to sell out of your business. So it's very simple, really, even though it has become this massive industry where people get degrees and jobs and make millions of dollars in some cases to be in this world. And so it's a massive, massive industry. Buying stocks is actually the easiest second revenue source that I'm aware of. It is so simple to create an account, fund your account, and most of these firms, there's no minimum amount you can fund it with too. So you could put in $500 and you're in. You could buy several different companies, because a lot of companies sell stock for under $10 per share. Others, like Amazon, it's like $3,000 per share. So there's a major range in which you can participate. Literally, you sign up, fund it, buy a share of a company, and you're good. So you don't have to really actively manage it much. There's no boss, there's no tenants, there's no one you need to really report to except for taxes at the end of the year. And if you never sell your stock, you're not going to have any income, so there's not going to be any taxes unless your stock pays a dividend, which some do. And a dividend is essentially where the company shares the cash with the owners. You know, some companies pay 0.5% a year, others pay up towards 6 or even 7% a year, and so you might actually get a cash dividend, which could, if you had a lot of money in, could turn into a monthly income stream. So that's how the stock market works. It's very basic. So my next video will be a little bit more detailed on like how to actually sign up and make your first purchase and how you analyze a stock and some of those things. So stay tuned. I'll walk you through the entire process.